Hello, everybody. Joshua Hayes at BigWaveTrading.com. What a week it has been. Following Jackson Hole, everything has changed in the overall market. If previous biases and narratives are not changed and adapted in a market that is driven by algorithms and an untrustworthy Fed, you are not a professional trader. The only traders or investors out there that hold on to narratives or biases when presented with new information do not do it for a living. That's the bottom line. And following Jackson Hole on Friday, we got new information that things have changed. And following this past week, further confirmation that this bounce off the June lows is in deep, deep, deep trouble. So first off, want to make mention here at the June lows, I was upset that we were bouncing and rallying because I didn't get my 50% cash on hand load with the SPY close at 350, which is what I really wanted. As we started to move away, I added a little bit to the long-term portfolios, but I maintained discipline and never chased. Then we reconstituted the quarterly portfolios. Did I chase those quarterly portfolios higher, or did I tell everybody we're going to stay cash and wait for 21 EMA reclaims on these top quality stocks? That is exactly what we've said. So long-term, I maintain I have not added to any long-term portfolios during this entire uptrend leg until on Friday in my most aggressive portfolio following this hammer candle on Thursday. I bought with 25% cash on hand in my most aggressive long-term account. I went ahead and went into leveraged ETFs, knowing that it's impossible to time the market and make it a perfect bottom call. Now, all of this being said, is the June low still in play? Absolutely. It sure is. I want to remind everybody that the reason why I thought and still might have bottomed here in June, sentiment, tactical sentiment got horrible. CNBC survey, the most bearish, even more bearish since 2008. Bank of America, Bear Bull Index was at 0. And also there was I think consumer confidence was at the lowest level since 2008. So sentiments-wise, we hit all the levels, AAII, II, we hit all the levels necessary to have a bottom. However, what were we missing? What were we missing? The most important things that I need to see for a market bottom, we were missing. We never got a VIX over 40. We never got the equity put call ratio over 1. We never saw any equity outflow. And in fact, during this downtrend in the market, we are actually at highs with equity inflow. That has never happened during a 20% market sell-off. And a lot of experienced market technicians and traders think and believe and know that market bottoms occur when there's equity outflow. So we didn't have equity outflow. We still have inflows. We didn't get a VIX over 40, and we didn't get an equity put call ratio actually closing over 1. All of these reasons kept me like, all right, man, we bottomed. Sure, I'm cool with that on sentiment. But why didn't we see it in any of the fear gauges that work with price? That was my biggest problem. The other issue that was happening was following this rally, as we pulled back, we saw 0 sweeper activity in fresh brand new leaders. That includes stocks that like were on my watch, like CLFD, for instance, RXDX, for instance. Didn't see any fresh sweeper activity in any of those names. So didn't see any of that. Then on this rally here, 0 major call sweeper activities in any fresh leadership names. And on this pullback here, where you really want to see the sweeper activity come into the fresh, new, hot names, there's been none. So we have no sweeper activity from the big money, indicating that we have a bottom. We have no VIX over 40, no equity put call over 1, no equity outflow. So as far as I'm concerned, without those variables in a bottoming equation, you can't have a bottom. Could you have it with sentiment? Sure. I was open-minded to it. And as we rallied and got above the 100 SMA and went to the 200 SMA and cleared the 50 Fibonacci retracement level, whenever we draw a Fibonacci retracement level from these highs, to these lows right here, you'll see that we took out the 50% Fibonacci retracement level. Any stock market that's ever declined 20%, once you clear 50% of that decline, the bottom is usually in. We've had a ton of 90% breadth thrusts recently in multiple volume and price indicators. Normally when you get that, a bottom's in. However, welcome to the new market that we're in. You can't trust this Fed. You can't trust what they do. You can't trust what they say. If you don't believe me, think about 2018 and just think about how algorithmic based driven this entire stock market is. So it's a kind of a weird situation here. When I look at the Fibonacci retracement level from the highs to the lows, we are currently holding the 61.8 or 23.6 Fibonacci retracement level. That is the bottom. Like, we got to hold here. If we break below this low, statistics tell us that we're going to retest the 360 level. So we'll see if that happens. So we have this Fibonacci level, drawn here. We have that one. Now, let's take it from the recent lows to the recent highs at the 200 SMA. What also lines up with that? The 61.8 Fibonacci retracement level. So we have a confluence of two Fibonacci retracement levels from the the ultimate high to the ultimate low, the recent ultimate low to the recent high right here. So this is a critical line in the sand, which I believe I've already shown you in the last video lesson is a clear support level for me. If we break this, we will revisit here. Now, with those Fibonacci lines on there, I now want to add an anchored VWAP to this low. Are we trading above or below the anchored VWAP on the low? We're currently below, which means the average participant from this low is now underwater. So that's a key level there. Now let's go to the current high and draw, right there. That's going to act as resistance moving forward. Let's draw an anchored VWAP. Better do the repeat from this high. See where we're at in relation to that. We're below that one. Let's draw an anchored VWAP to this high. See where we're at in relation to that. I can't even see where that one comes through. Right here. Okay. So we are below 4 critical anchored VWAP levels. From this high, from this high, from this high, and this low, we're below all of the anchored VWAPs. So these areas, these Fibonacci retracement lines, are going to act as resistance levels. The anchored VWAPs are going to act as resistance levels. This area is going to act as support. On top of that, what makes it hard to see, and that's the whole point of all this, look at where the 50, the 5, the 9, the 21, the 100, and the 200 SMA. How many support levels do we have using all of these indicators are below price compared to what is above price? What looks like the path of least resistance for price? Lower, right? On top of that, we're in September. Do you guys know, historically, going back to 1950, what's the worst month in the stock market for returns? September. Did you guys know that from September 3rd to September 10th, we average annualized a 14% decline in September? Did you know from September 17th through September 26th since 1950, the annualized return for the S&P 500, not average, the annualized return for the S&P 500 since 1950 from September 17th through the 26th is negative 28%. So if you cumulative gain of negative 14% from the 3rd through the 10th and negative 28% from the 17th through the 26th through 1950. This is the worst month historically. And we have an aggressive Fed that says that they're definitely, on the warpath. So the path of least resistance is lower. So what's my game plan now following the past week? Well, in the last video lesson, I told you I was doing my long-term portfolio, right? SPY closes at 390 or lower. Whatever available cash is on hand, 50% of it, slamming it into my leaders. It's a list of 10 stocks and then some leveraged ETFs and some other dividend-producing ETFs. So there's other stocks too. There's then like 20 names that are like secondary. That was the game plan If the pullback was normalized with the increasing volume each and every day, with the market looking weaker and weaker, with now us being in September, I'm no longer waiting for a close at or below 390. Following Monday's session, I change it from a close at or below 390 to a close at or below 390 with a bullish hammer. Then I'll do the 50%. After this week, I now think I'm going to go ahead and get my lower prices in the market. Whenever I add size to my long-term portfolios, I will let all members know. However, for now, I am taking a step back. If the SPY closes below 390 and gives me any kind of reversal, I'm willing to put 25% of the cash on hand into my long-term positions. However, based on the current price action and what we've seen since Jackson Hole, I'm going to need to see the market actually find a floor, and I would prefer to see some equity outflow. I would prefer to see that equity put call rise. I would prefer to see that VIX get near 40 before then I think of doing any loads. So what I will do instead is piecemeal it until I get those load signals or Fed pivot. What's a Fed pivot? We're no longer hiking rates, and or we're cutting rates, and or we're halting QT, which, by the way, is increasing this month. So keep that in mind. That's going to be added pressure against stocks. So along with all of these levels, there's also major support. Also happens to line up here. You got these lows right here. This should act as support. So you have this level here, this level here, this level here. But now what I'm going to do as the market sells off, if it shows any kind of bottoming reversal at 380, I'll buy a little bit in the long term there. 370, same thing. 360, same thing. 350. And I'll just keep doing that all the way down. And my game plan includes the SPY going to 250. And if the SPY hits 250, I'll be all in. I'll be all in no matter how bad it gets down to there. And if the SPY goes to 150, do I care? I sure do not. Why? The long term is a 5 to 20 year time horizon. On top of that, the quarterly portfolios, hey, we reinstituted them this quarter. They've been dormant the entire year. I've done the reconstitution, given you the portfolio names, but this is the first quarter I was willing to be active. However, everything was so extended, I needed to see it go below the 21, reclaim the 21, and be in a squeeze for any of the names to be added to the portfolio. The quarterly portfolio is 100% cash. The long-term portfolio did not chase this move on the upside. The end-of-day swing accounts, at one point, I believe, as of a few weeks ago, was around 33+% invested. It's now only 10% invested. 90% cash, 10% long equities in the end-of-day swing account. That's my game plan moving forward. I'm still looking for swings when they set up. If they're in leading industries, leading stocks, cancel them, quality, still willing to do that. But my great personal setups that I love, my volume truncations, my BOP surges with price at critical support levels, or the 5200 SMA, beautiful chart full of green. So how my charts look, they're just not there. So I'll be sticking with the cancel them side. But right now, my time frame of focus, and it's been like this the whole year. I called 2022 the year of the active trader. This was going to be an active trading market. I switched. The vast majority of my capital is in day trading accounts. I'm a day trader right now. That's my main time frame of focus, is day trading. And it's going to remain that way until we get some stability in the market and things make sense again. As long as algos are doing this 90% up and down thing, it's going to be tough. And I tell you what, it's going to be hard to be bullish in this market whenever I look at NVIDIA. And NVIDIA, one of my favorite stocks, is hitting new 52-week lows. I have a feeling SPY and QQQ can follow suit if NVIDIA is doing the same thing. And I haven't even checked junk bonds yet. But look at junk bonds. They're getting pretty close to hitting new lows. So keep an eye on that as well. If that hits new lows before the SPY does, the SPY will be hitting new lows. And for anybody wondering if I still think this is a cyclical bear and not a secular bear, Let me get rid of everything. I just want to reference the 200 SMA and remind everybody on the weekly time frame. Yes, this can turn into a secular bear, but you're not going to see me become a full-on bear until we get below the 200, retest it, and then fail. Once we retest the 200 weekly SMA and then get below the most recent low, you're in a secular bear. That's 2008 there. If you look at 2000 back here, you get below the 200, you retest it, you break this low, you're in a secular bear. Where are we at right now relative to the 200 weekly SMA? Now, that being said, there is one concerning setup on a long time frame. This is a monthly chart of the QQQ. Let's see. Let's just go to 2009, get this close up here. So in 2009, this is going to be hard to see. You're going to notice this green line crossed above this blue line, okay? That green line has stayed above the blue line the entire time since that cross in 2009 until the closing of this last month. The green line has crossed below the blue line. The 9 EMA has crossed below the 21 EMA on the monthly time frame on the QQQ for the first time since 2009. Uh-oh. That can't be good. We'll see. Maybe it is. Maybe we find support here, rally back, quickly get the 9 above the 21. But I did notice that at the end of the month. That's not good. But to get me personally to become a secular bear, we got to get below the 200, test it, and then fail. Sorry, until that happens, this is a cyclical bear and a secular bull. Everyone, I figured we'll end this video lesson as a thank you for watching and learning and furthering your education in the stock market. I'm going to go ahead and give you guys my new swing trade idea that I am going to attempt to get long on Monday. GRIN, GRIN. This stock is can slim quality, has an 81 EPS rating, number 3 in its industry group. I'll just give you that much information there. It is also in my perfect speculator scan. This looks at the best stocks that have historically had these conditions before they then go on to make more explosive gains. Normally in the past 52 weeks, they're up at least 100%, and they're within 20% of their 52-week high. GRIN qualifies via both of those metrics, including being near its all-time high. So what I see here on GRIN, it's already part of a long uptrend. We have a cup forming here, and so far a very short handle following earnings gap ups. Don't know which one was due to earnings. Can't remember. Who cares? I don't care because I'm only trading price. So what I have here and why I'm getting long is because GRIN is a leader. Shipping isn't necessarily the strongest sector, but it's holding up shipping, energy, and utility stocks. And I got 2 utility names we'll take a look at too at the end that I'm actually not going long on Monday, but you can set up orders appropriately. So GRIN has a bullish hammer candle over candle, holding the support lows of this gap up that was on volume truncation and a mini BOP surge. I would have much rather seen BOP surge to max green, hold max green, but after the surge and solid pullback with bullish hammer candles, especially relative to the recent market price action, even though volume was slightly heavier, held very well, bullish reversals, and BOPs increased a little bit. So, to me, GRIN is good enough to try. Now, in a raging bull market where all of our indices are above the 8, 21, 34 EMAs, with those EMAs above the 50, 100, 200 SMA with the proper stacking, with this being canceling and perfect speculator quality, I probably risk 5R on this trade. I could probably get half of my portfolio involved in this trade. But if you think I'm going to size into GRIN like I would in a strong market where shipping stocks are breaking out left and right and other sectors and other stocks are breaking out left and right and the Fed's under QE and there's no QT and they're cutting rates and they're dovish compared to what's going on now, you're nuts. This is going to be a piker-sized trade, and if it works, great, and if it doesn't, I don't care. That's just how it goes, guys. That's trading. So I want to get long at 24.38, 1 cent above the high of the day. If it doesn't gap up, you can get long at the market. But the only thing you need to know is If it doesn't move higher immediately and undercuts 22.49, if it prints one trade on the time and sales at 22.48, I'm out. I'm gone. But GRIN, this is a very nice setup. I like the way it looks. But more importantly, let me show you this setup. Also, what GRIN has going for it for me here is that it's triple green, TSV, MACD, CMF on the daily, and it's triple green, TSV, MACD, CMF on the weekly. That's pretty awesome. On top of that, we have something that we call the tickets indicator. It's from our in-house coder, programmer, tickets, Chris. We are above the zero line on the hourly, above the zero line on the daily, and above the zero line on the weekly. So pretty solid setup. So we're getting late in the video lesson. I'm going to give you two more stocks. The only sector this past week that showed any relative strength was XLU, and I think that should tell you everything. XLU currently has a sloppy, it's basically an inverse head and shoulder, shoulder, head, shoulder, handle, inverse head and shoulder with handle forming. And I got two leaders for you to keep on watch. SRE has a very similar pattern. You can draw a downtrend line above these highs, and if it breaks out above it, you can get long, risking to either this low or this low. And however you sized in is completely dependent on your personal risk tolerance. But SRE is a leading stock and a leading industry group that's holding up very well relative to the market. It's not saying a lot. Just want to show you guys how I see the market, where my focus goes. The other one I'll show everybody is SO, Southern Company. Similar kind of inverse, head and shoulder. Didn't even form a handle. Now it's forming a high handle. So you have an inverse head and shoulder with high handle. Same thing. Draw a downtrend line, breaks out, you get long, you risk to this low, or you risk to this low, or these moving averages. And that's how it goes. All right, everybody. I love you. Thank you very much for watching the video lesson. You know what to do. I don't need to tell you what to do. If you find all of this information valuable, in the description below, you'll see additional links to join our team. All right, everybody. Have a wonderful rest of your long Labor Day weekend, and I will see members in the chat room during the pre-market Tuesday morning. Aloha.